And for more analysis on Wall Street, we've got Tony Nash, founder and CEO of Complete Intelligence. Tony, appreciate your time today. So we saw there the data adding to concerns of a weakening labor market. How much sway do you think this will have when the Fed meets next week? I mean, markets are expecting a cut, but before this, we heard policymakers quite divided in what they're going to do next.
Yeah, it's a good question. I think one of the big issues that we've kind of forgotten about in the past week or so is the fact that the U.S. government was closed for 8 weeks. And so to see the employment numbers negative for the month of November actually isn't really that surprising, because the U.S. government is the largest employer, the largest spender in the U.S. economy. And to see only 30-some thousand jobs, I know it's terrible. Every job lost is hard, but to see 30-some thousand jobs lost, these are small companies just being very conservative about their spend while the U.S. government was closed. So I don't find that all that surprising. There is an expectation that all those Fed dollars from the close and whatever needs to be spent in December is all going to be spent before the end of the calendar year. So we should see an uptick in spending and sentiment and equities going into the end of the year. Nonetheless, the employment picture is difficult. We are seeing this K-shaped recession where people at the lower ends are finding it very difficult and people at the higher ends are finding it easier to spend. So the Fed has a bias toward cutting in December. I think they're going to cut 25. I think, we have a new Fed chair coming in, probably I think April of next year is when it's going to happen, with a very dovish bias. So I think there's a bias toward even more cuts going into 2026.
Yeah, so with more cuts going into 2026, what we did see overnight, too, we got some tech earnings, Salesforce, Snowflake posting strong earnings. We talked about Microsoft denying the report there that they are lowering sales quotas on AI products. What's your sense of how much support AI could give the broader rally on Wall Street against the backdrop of a Fed that's expected to cut rates?
Yeah, I think AI will give a lot of strength because we have a lot of data center investment that's been announced. Some of it has yet to be executed. That will give a huge tailwind to the economy. More accommodative monetary policy will make borrowing easier for those companies to pay for those data center buildouts and new services and other things. So I think tech is going to really help the U.S., especially in the first half of 26. I might expect the second half of 26 for that to lighten up a little bit, but at least in the first half, I think tech and AI are going to be huge tailwinds for the U.S. economy.
Yeah, what's interesting, too, that what we saw overnight, we've got the Russell 2000 jumping 1.9%, outpacing other benchmarks on this greater expectations of a Fed cut this month. Do you think that is the missing piece that these small caps need next year to join the broad rally? Is increased Fed cuts going to support them broadly next year?
Yeah, I think you're right. So with lower monetary cost, with the cost of borrowing being lower, small companies will have more access to capital and they'll be able to fund their operations more easily. So if they want to expand in the pathway of these AI developments, it'll be easier for them to do so. So, what we have in a constrained borrowing environment is it's easier for big companies to expand because they have the cash to do it and they have preferential credit lines. Small companies just don't. So they pay more for money to borrow, they pay more to expand, and the competition for talent is tougher, so they pay more for people as well. So I think you will have small caps that are coming in the back of a lot of these AI developments and really helping these companies in smaller ways as vendors, as service providers, and as product providers.
Yeah, and expectations of further U.S. rate cuts really weighed on the U.S. dollar after quite a tough year, and that's weighed on U.S. holdings of foreign investors. With more rate cuts expected, what's the picture now for the dollar?
Well, I don't think that the current administration has an issue with a weaker dollar. Every president voices that they want a strong dollar, but we have to keep in mind when Donald Trump left office in January of 2021, The US dollar on a weighted basis was at 91. Today it's at 98.8. So I don't think a Trump Treasury Secretary or a Trump Fed has a problem with a weaker dollar. And so the Fed issues and the Fed activities weakening that dollar, it won't have a political problem. It'll help US exporters as well. So I think that's likely for 2026, definitely weaker dollar.
All right, we'll watch that, Tony. Appreciate it. Tony Nash there, founder and CEO at Complete Intelligence.